What's up everyone, it's Caddy with MoneyVest. So in this video, I wanted to go over the current state of the bond market, more specifically the treasury market here with the 10-year yield hitting almost as much as 5%. So I'm going to break down another really concerning catalyst and report that was released today suggesting that the fiscal department once again is going to run a deficit of close to $1.7 trillion in the year 2023. So we're going to cover all of that in this video. Hope you enjoy it, find it helpful. All I'm asking in return is that you drop a like and, of course, subscribe to the channel. And link to our Discord and Patreon is going to be down below if you're interested in joining. Of course, getting access to all the buy and sell alerts, options alerts, trade ideas, members-only videos, and the early access to the MoneyVest Pro platform that's going to be available in 2024. So all you have to do right now is either go to the link down below in the description or in the pinned comment, or simply go to moneyvest.com. That's going to be the website. You can go there and, of course, get early access. We are going to be launching this very soon. Super excited. We're putting a lot of time and effort and resources and energy into this platform, which is going to really not just be a fintech platform, but it's going to be a data science platform where you can access a ton of data and, of course, different types of metrics to look at for macroeconomics and fundamental analysis. So again, link's going to be down below. We'd love to have you on board. And on top of that, you'll also get access to our MoneyVest fair value. So in the meantime, we have created this Excel spreadsheet which everyone can view, and that will basically have, all of our stocks here that we're analyzing. So for example, these are all of our stocks that we obviously look at. And you can look at the market price, and you can also look at the intrinsic value for these companies. There's going to be a column specific to the intrinsic value where you can take a look at where I've calculated the intrinsic values, the fair values to be, and you can kind of compare and see, how much of a difference there is, what a percentage drop needed in order for stocks to be trading at their intrinsic value. So all that's going to be available, again, in a nice, very nice put together Excel spreadsheet. So link's going to be down below. And we also highlight some risks that you need to watch out for these companies. So we'd love to have you on board. So this right here is something that I saw on Twitter, which I thought was very interesting and creative. This right, basically the army of bears kind of leading charge here, and somebody saying, all right, spread out, boys, and remember, no prisoners. And I think it's going to be very interesting how the market dynamics kind of create here with the bond market, with especially the treasuries now sitting at well over 10%, because on one hand, you've got the treasury yield expected to go even higher to 5.25%, 5.5%, almost as much as 6%, depending on what happens on the treasury side with the deficits and the debt. And on the other hand, you've got an expectation that eventually a higher yield is going to attract a lot of buyers, and then that's going to lead the bond market higher and yields to come back down because, again, it's all dependent on demand and supply. If there's a lot of demand for treasuries, well, buyers step in, prices go higher, and since yields move inversely to price, they come back down. So there is going to be, like I said, a very interesting dynamic in the market and what ends up happening more specifically with equities, right? Because that's really what we're here to discuss is what's going to happen with the stock market, right? With given how what's happening with the bond market. So there's been some concerns that, the market is going to relive its 1987 crash. So this right here was about 37 years ago. So if you do the math, 2023 minus 1987, 36 years ago, we're coming up to the anniversary of Black Monday, which was a very significant sell-off in the Dow Jones, and the markets were down, I think, over 20% in one single day. And this was the headline from Tuesday, the following day, October 20th, that world markets collapsed, and we obviously did see a pretty significant sell-off, and bonds fall, push rates higher. So, there's been a lot of expectation that there's going to be something very similar on Monday, which marks the 36th anniversary of Black Monday in 1987. And people are driving these correlations that, oh, look, the NASDAQ's progress this year is very similar to the Dow in 1987. This right here was the crash during the Black Monday, and NASDAQ 100 is kind of going through something very similar. I doubt it. I think there's been a lot of technology in place for circuit breakers like these, and the moment markets drops over certain thresholds, I think it's just going to be closed for the rest of the day if that ends up happening. I doubt it's going to happen. Yes, there's expectations that volatility is pretty elevated. It's starting to move back higher. Long-dated treasuries are on the way up as well. So there's definitely some concerns, but for me, I don't think that is going to really take place. unless, of course, something catastrophic comes out in the media, in the news, something that really does spook investors altogether, and we do see 3, 4, 5, 6% sell off. So it would still be something that we have already witnessed and seen in the past. I mean, 20% would be pretty significant, and I don't even think that we're gonna get down there given how many circuit breakers we have in place. So that's something to keep in mind. That's something that we can kind of ignore and kind of focus on the bigger problem, which is the U.S. budget deficit swells to 1.7 trillion in fiscal 2023 as revenue tumbles. So revenue has been coming down, and I've mentioned before in one of my previous videos that the U.S. IRS is now starting to go after a lot of people. Like, they're going after wealthy individuals, they're going after businesses. I mean, Microsoft was issued a notice that they owe over $50 billion in back taxes, which Microsoft is going to contest and fight in court. I think it makes complete sense, right? They've said that they have complied with all U.S. regulations and tax laws, and they don't owe anything, right? And the IRS is still going after them. The IRS is also going after wealthy individuals. I also mentioned that the IRS issued a notice to me from 2019 saying that I haven't filed my Massachusetts state taxes, and they kept putting on this balance with interest and penalties. And I specifically mentioned that in 2019, I wasn't even working full time. I was in school, and I did file my taxes. I pretty much mentioned it on the call, and I submitted this document signed showing them my returns from 2019. But they're just so stubborn. They're just so reluctant going after people and businesses to try to collect as much revenue as possible because tax receipts have been lower in 2023. They mentioned that the sharp decrease in tax revenue was due to lower individual income tax receipts as capital gains realizations fell. So people are not realizing capital gains. Makes sense because 2022 was such a significant sell-off, bear market, and 2023 we're just seeing a recovery, so there's not really a lot of capital gains to realize, and to rising interest rates that cut the amount of money the Federal Reserve deposited at the Treasury. So obviously there's a couple different reasons, but the deficit continues to go up, and there is a tsunami of supply of bonds because the fiscal department has to fund all these deficits somehow, right? They have to fund all the deficits that are running to spend by issuing a lot of bonds. And the total amount of Treasury securities outstanding has now reached over $33.6 trillion. Of that amount, 7.5 is held by the government, right? So government pension funds, Social Security, Medicare, all those different types of programs. But 26.5 trillion is public debt, right? So 26.5 trillion is held by foreign holders. So Japan being the number one foreign holder of U.S. treasuries, followed by China, followed by Luxembourg. We got Australia, we got India, we got Europe, a lot of different countries that actually have U.S. denominated debt. They are some of the other ones on the list. And of course, we got the banks, the bond funds, insurance companies, individuals like you and I. So we also have, if you have bonds through Treasury Direct, you are basically lending your money to the U.S. government. In return, they're paying you an interest rate. Right? So these securities held by the public spiked by nearly $1.8 trillion in the 5 months since the end of the debt ceiling standoff. Can you imagine? Like $1.8 trillion already, and by over $10 trillion, or by 65% in 5 years, from 16 trillion to over $26.5 trillion right now. So what's happening right now is that the supply is ever growing, and the amount of debt being issued by the U.S. government is increasing at a faster rate than the market can absorb, right? And thereby there's an imbalance between the demand and supply, and this is expected to continue. So the demand by the biggies, international holders in the Fed, Japan number one, has increased its holding to over 1 trillion. China and Hong Kong combined, the number second U.S. creditor, further reduced their holdings. I did a video on this where China's holdings are going down as they're dumping U.S. Denominated debt, and I think over $21 billion worth of debt was, unloaded in the month of August from China. And the top 6 financial centers, London, Belgium, we got Luxembourg, Switzerland, Cayman Islands, and Ireland, increased their holdings to a record $2.27 trillion. So while these 6 financial centers are increasing their holdings, it is nothing compared to the amount of offloading that's happening from China and Hong Kong, and Japan obviously is basically flat and slightly down, and all other countries, including India, and I think some of the other ones are also increasing their holdings of U.S. securities. But as a percentage of overall public debt, it's going down. So, right? So in other words, foreign holders' share as a treasury securities held by public is going down, right? So that's a problem. I think that's something that we need to discuss, because who else is going to be buying at that size and scale, right? the general population is not going to make up for $1 trillion in public debt, right? Holdings, pension funds, maybe, insurance companies, maybe. And on top of that, right, you've got the Federal Reserve that's doing some quantitative tightening at the same time, right? So you're not basically your biggest buyer at the Fed during quantitative easing was buying hundreds of billions of dollars worth of U.S. debt during that time to support the economy and keep interest rates artificially low, right? Because if the Federal Reserve itself is buying treasuries from the fiscal department, they're creating this artificial demand, right? So they're printing money and they're buying debt to keep interest rates low, and that's only happening artificially because once they pull back, then the market is free to function as the buyers and sellers see fit. And that's exactly what's happening right now. During the pandemic, during the quantitative easing period, the Federal Reserve was buying a lot of treasuries, buying a lot of debt to keep interest rates suppressed artificially. But once they kind of go away, now the market's free for all. It can actually move on the market dynamics. And that's exactly what's happening with the 10-year treasuries hitting almost as much as 5%. And if this number continues to go up, right? This is not an overstatement, folks. If this number continues to go up, it will create a bigger and bigger and bigger problem for the market, for equity markets, I specifically mean, because we already learned what happened with the S&P last week, right? It was down over 2.3%, rightly so. NASDAQ here down more, down over 3%, rightly so. A lot of stocks were selling off, right? Tesla was down 15%. Apple was down a little bit over 3.3%. We had Amazon sell off a little bit over 3.5%. We had, Nvidia, for example, sell off down over 8.9, almost 9%. Now, look, there might be some specific reasons. Tesla's earnings, Nvidia's, sell off due to the U.S. putting sanctions over China, and of course the restrictions with specific chips that can be exported over to China so that they don't weaponize them to create these military systems and advantages. There might be specific reasons, but the bottom line is the increase in treasury yield puts a lot of pressure on equity valuations, right? Because we're no longer working with an environment where rates are low and these companies can easily borrow money, invest in their businesses, and continue to grow at a very rapid clip, right? Higher interest rates is going to put a very significant, challenging environment for the markets to rally. That's probably the number one reason, right? Why it's going to become increasingly more difficult for equities to stay at these levels, sustain these levels, if there isn't demand that shows up quick, right? If the U.S. Treasury, if there's no demand at 5%, and the demand is basically waiting, right? If the demand doesn't overpower supply anytime soon, well, it's possible that yields slowly and steadily continue to climb higher, and that's going to put a lot of pressure and make it harder, right? So it's going to be challenging for the market to rally. It's going to basically restrict market's ability to push higher. So that's where we are. I think it's going to be an interesting sort of a dynamic, like I said, between the bond market and the equity markets and how it ends up sort of all playing out. But I'm cautious here just for the macro perspective. I'm not really deploying cash left and right, but instead watching a few different indicators like the volatility, percentage of stocks trading above or below their moving averages. I think those are very important to watch. Of course, market's valuation, and not to mention the intrinsic value spreadsheet, kind of going over, what our fair values are for individual stocks to better understand where those opportunities might be. So again, link's going to be down below if you want to join and get access to all these spreadsheets, members only private videos, and also our stock reports that are going to be available. Link to our Discord patrons down below. As always, make sure you drop a like. Don't forget, sign up for the early access at moneyvest.com. That's where you can go and sign up. Hopefully you enjoyed this video, found it helpful. If you did, make sure you drop a like, and don't forget to subscribe to the channel. And let me know in the comment section below, what do you think about the market dynamics here? And like I said, the bond market is going to make it difficult for the market, stock market, equity markets to rally right now at this moment. So as always, happy investing. I'll see you all in the next video.